The World Health Organization, WHO, first declared COVID-19 a World Health Emergency in January 2020. Since the virus was first diagnosed in Wuhan, China, it has been detected in over 190 countries. More than 80 countries have closed their borders to arrivals from countries with infections, ordered businesses to close, instructed their populations to self-quarantine, and closed schools to an estimated 1.5 billion children. The outbreak of pandemic coronavirus all over the world has distorted the political, social, economic and financial structure of the whole world. World's topmost economies such as the US, China, UK, Germany, France, Italy, Japan, India and many others are at verge of collapse. Global trade and GDP are forecast to decline sharply at least through the first half of 2020. The global pandemic is affecting a broad swath of international economic and trade activities, from services generally to tourism and hospitality, medical supplies and other global value chains, consumer electronics, and financial markets to energy, transportation, food, and a range of social activities, to name a few. The health and economic crises could have a particularly negative impact on the economies of developing countries that are constrained by limited financial resources and where health systems could quickly become overloaded. Impact on global growth. The economic situation remains highly fluid. Uncertainty about the length and depth of the health crisis-related economic effects are fueling perceptions of risk and volatility in financial markets and corporate decision-making. Compounding the economic situation is a historic drop in the price of crude oil that reflects the global decline in economic activity, prospects for disinflation, and contributes to the decline of the global economy through various channels. The Organization for Economic Cooperation and Development, OECD, on March 2, 2020, lowered its forecast of global economic growth by 0.5% for 2020 from 2.9% to 2.4%, based on the assumption that the economic effects of the virus would peak in the first quarter of 2020. On March 26, 2020, the OECD revised its global economic forecast based on the continued effects of the pandemic and measures governments have adopted to contain the spread of the virus. According to the updated estimate, the current containment measures could reduce global GDP by 2.0% per month, or an annualized rate of 24%, approaching the level of economic contraction not experienced since the Great Depression of the 1930s. Labeling the projected decline in global economic activity as the Great Lockdown, the IMF released an updated forecast on April 14, 2020. The IMF concluded that the global economy would experience its worst recession since the Great Depression, surpassing that seen during the global financial crisis a decade ago. In addition, the IMF estimated that the global economy could decline by 3.0% in 2020, before growing by 5.8% in 2021. Global trade is projected to fall in 2020 by 11.0% and oil prices are projected to fall by 42%, also shown in table. This forecast assumes that the pandemic fades in the second half of 2020 and that the containment measures can be reversed quickly. The IMF also stated that many countries are facing a multi-layered crisis that includes a health crisis, a domestic economic crisis, falling external demand, capital outflows, and a collapse in commodity prices. In combination, these various effects are interacting in ways that make forecasting difficult. Global trade, according to an April 8, 2020, forecast by the World Trade Organization, WTO, global trade volumes are projected to decline between 13% and 32% in 2020 as a result of the economic impact of COVID-19. The WTO argues that the wide range in the forecast represents the high degree of uncertainty concerning the length and economic impact of the pandemic and that the actual economic outcome could be outside this range, either higher or lower. The WTO's more optimistic scenario assumes that trade volumes recover quickly in the second half of 2020 to their pre-pandemic trend, or that the global economy experiences a shaped recovery. The more pessimistic scenario assumes a partial recovery that lasts into 2021, or that global economic activity experiences more of a U-shaped recovery. The WTO concludes, however, that the impact on global trade volumes could exceed the drop in global trade during the height of the 2008 to 2009 financial crisis. Economic development. Between late February and April 2020, financial markets from the United States to Asia and Europe have been whipsawed as investors have grown concerned that COVID-19 would create a global economic and financial crisis with few metrics to indicate how prolonged and extensive the economic effects may be. Investors have searched for safe haven investments, such as the benchmark U.S. Treasury 10-year security, which experienced a historic drop in yield to below 1% on March 3, 2020. In response to concerns that the global economy was in a freefall, the Federal Reserve lowered key interest rates on March 3, 2020, to shore up economic activity, while the Bank of Japan engaged in asset purchases to provide short-term liquidity to Japanese banks. Japan's government indicated it would also assist workers with wage subsidies. The Bank of Canada also lowered its key interest rate. The International Monetary Fund, IMF, announced that it was making about $50 billion available through emergency financing facilities for low-income and emerging market countries and funds available through its Catastrophe Containment and Relief Trust, CCRT. Reflecting investors' uncertainties, the Dow Jones Industrial Average, lost about one-third of its value between February 14, 2020, and March 23, 2020. Expectations that the U.S. Congress would adopt a $2.0 trillion spending package moved the Dow Jones Industrial Average up by more than 11% on March 24, 2020. From March 23 to April 15, the Dow Jones Industrial Average moved higher by 18%. Since then, the Dow Jones Industrial Average has moved erratically as investors have weighed news about the human cost and economic impact of the pandemic and the prospects of various medical treatments. For some policymakers, the drop in equity prices has raised concerns that foreign investors might attempt to exploit the situation by increasing their purchases of firms in sectors considered important to national security. Ursula von der Leyen, President of the European Commission, urged EU members to better screen foreign investments, especially in areas such as health, medical research, and critical infrastructure. On March 5, the U.S. Congress passed a $8 billion spending bill to provide assistance for health care, sick leave, small business loans, and international assistance. At the same time, commodity prices dropped sharply as a result of reduced economic activity and disagreements among oil producers over production cuts in crude oil and lower global demand for commodities, including crude oil. Ahead of a March 12, 2020, scheduled meeting of the European Central Bank, ECB, the German Central Bank, Deutsche Bundesbank, announced a package of measures to provide liquidity support to German businesses and financial support for public infrastructure projects. At the same time, the Fed announced that it was expanding its repo market transactions. In the repurchase market, investors borrow cash for short periods in exchange for high-quality collateral like Treasury securities. After stock market indexes fell sharply, government bond yields fell to record lows, reflecting increased demand, and demand for corporate bonds fell. Together these developments raised concerns for some analysts that instability in stock markets could threaten global financial conditions. On March 11, as the WHO designated COVID-19 a pandemic, governments and central banks adopted additional monetary and fiscal policies to address the growing economic impact. European Central Bank, ECB, President-designate Christine Lagarde in a conference call to EU leaders warned that without coordinated action, Europe could face a recession similar to the 2008 to 2009 financial crisis. 44 The Bank of England lowered its key interest rate, reduced capital buffers for UK banks, and provided a funding programme for small and medium businesses. The UK Chancellor of the Exchequer also proposed a budget that would appropriate £30 billion, about $35 billion, for fiscal stimulus spending, including funds for sick pay for workers, guarantees for loans to small businesses, and cuts in business taxes. The European Commission announced a €25 billion, about $28 billion, investment fund to assist EU countries, and the Federal Reserve announced that it would expand its repo market purchases to provide larger and longer-term funding to provide added liquidity to financial markets. President Trump imposed restrictions on travel from Europe to the United States on March 12, 2020, surprising European leaders and adding to financial market volatility. At its March 12 meeting, the ECB announced €27 billion, about $30 billion, in stimulus funding, combining measures to expand low-cost loans to Eurozone banks and small and medium-sized businesses and implement an asset purchase program to provide liquidity to firms. Germany indicated that it would provide tax breaks for businesses and unlimited loans to affected businesses. The ECB's Lagarde embroiled markets by stating that it was not the ECB's job to close the spread between Italian and German government bond yields, a key risk indicator for Italy, a comment reportedly interpreted as an indicator the ECB was preparing to abandon its support for Italy, a notion that was denied by the ECB. The Fed also announced that it would further increase its lending in the repo market and its purchases of Treasury securities to provide liquidity. As a result of tight market conditions for corporate bonds, firms turned to their revolving lines of credit with banks to build up their cash reserves. The price of bank shares fell, reflecting sales by investors who reportedly had grown concerned that banks would experience a rise in loan defaults. Despite the various actions, the Dow Jones Industrial Average fell by nearly 10% on March 12, recording the worst one-day drop since 1987. Between February 14 and March 12, the Dow Jones Industrial Average fell by more than 8,000 points, or 28% of its value. Credit rating agencies began reassessing corporate credit risk, including the risk of firms that had been considered stable. Now let's have a look at each economy. China. According to a recent CRS in Focus, China's economic growth could go negative in the first quarter of 2020 and fall below 5% for the year, with more serious effects if the outbreak continues. In early February, China's central bank pumped $57 billion into the banking system, capped banks' interest rates on loans for major firms, and extended deadlines for banks to curb shadow lending. The central bank has been setting the reference rate for China's currency stronger than its official close rate to keep it stable. On March 13, 2020, the People's Bank of China announced that it would provide $78.8 billion in funding, primarily to small businesses, by reducing banks' reserve requirements. 146 The International Monetary Fund, IMF, is providing funding to poor and emerging market economies that are short on financial resources. If the economic effects of the virus persist, countries may need to be proactive in coordinating fiscal and monetary policy responses, similar to actions taken by the G20 following the 2008 to 2009 global financial crisis. Japan. The Bank of Japan, with already low interest rates, injected $4.6 billion in liquidity into Japanese banks to provide short-term loans for purchases of corporate bonds and commercial paper and twice that amount into exchange-traded funds to aid Japanese businesses. The Japanese government also pledged to provide wage subsidies for parents forced to take time off due to school closures. On March 24, 2020, Japan announced that the Summer Olympics set to take place in Tokyo would be postponed by a year, delaying an expected boost to the Japanese economy that was expected from the event. Japan reportedly is considering an emergency fiscal package of about $515 billion, roughly equivalent to 10% of Japan's annual gross domestic product, GDP. On April 27, 2020, the Bank of Japan announced it would purchase unlimited amounts of government bonds and quadruple its purchases of corporate debt to keep interest rates low and stimulate the Japanese economy. Europe. To date, European countries have not had the kind of synchronized policy response they developed during the 2008 to 2009 global financial crisis. Instead, they have used a combination of fiscal policies and bond buying by the ECB. Individual countries have adopted quarantines and required business closures, travel and border restrictions, tax holidays for businesses, extensions of certain payments and loan guarantees, and subsidies for workers and businesses. The economic effects of the pandemic reportedly are having a significant impact on business activity in Europe, with some indexes falling farther than they had during the height of the financial crisis and others indicating that Europe may well experience a deep economic recession in 2020. France, Germany, Italy, Spain, and the UK reported steep drops in industrial activity in March 2020. EU countries have issued travel warnings, banning all but essential travel across borders, raising concerns that even much-needed medical supplies could stall at borders affected by traffic backups. The travel bans and border closures reportedly are causing shortages of farm laborers in Germany, the UK, and Spain, which has caused growers to attempt to recruit students and workers laid off because of the pandemic. The European Commission announced that it was relaxing rules on government debt to allow countries more flexibility in using fiscal policies. The European Central Bank, ECB, announced that it was ready to take appropriate and targeted measures, if needed. France, Italy, Spain and 6 other Eurozone countries have argued for creating a Corona bond, a joint common European debt instrument. Similar attempts to create a common Eurozone-wide debt instrument have been opposed by Germany and the Netherlands, among other Eurozone members. With interest rates already low, however, it indicated that it would expand its program of providing loans to EU banks, or buying debt from EU firms, and possibly lowering its deposit rate further into negative territory in an attempt to shore up the euro's exchange rate. ECB President-designate Christine Lagarde called on EU leaders to take more urgent action to avoid the spread of COVID-19 triggering a serious economic slowdown. USA, in a sign of growing concern over strains in financial markets and economic growth, the Federal Reserve, Fed, has taken a number of steps to promote economic and financial stability involving the Fed's monetary policy and lender of last resort roles. Some of these actions are intended to stimulate economic activity by reducing interest rates and others are intended to provide liquidity to financial markets so that firms have access to needed funding. In announcing its decisions, the Fed indicated that the COVID-19 outbreak has harmed communities and disrupted economic activity in many countries, including the United States. Global financial conditions have also been significantly affected. On March 31, 2020, the Trump administration announced that it was suspending for 90 days tariffs it had placed on imports of apparel and light trucks from China, but not on other consumer goods and metals. U.K. The Bank of England announced on March 11, 2020, that it would adopt a package of 4 measures to deal with any economic disruptions associated with COVID-19. The measures include an unscheduled cut in the benchmark interest rate by 50 basis points, 0.5%, to a historic low of 0.25%, the reintroduction of the Term Funding Scheme for Small and Medium-Sized Enterprises, TFSM, that provides banks with over $110 billion for loans at low interest rates, a lowering of banks' counter-cyclical capital buffer to 0%, which is estimated to support over $200 billion of bank lending to businesses, and a freeze in banks' dividend payments. UK Chancellor of the Exchequer Rishi Sunak proposed a national budget on March 11, 2020, That includes nearly $3.5 billion in fiscal spending to counter adverse economic effects of the pandemic and includes an increase in statutory sick leave by about $2.5 billion in funds to small and medium businesses to provide up to 14 days of sick leave for affected employees. The plan also proposes to give affected workers up to 80% of their salary, or up to £2,500 a month, about $2,800, if they are laid off. Some estimates indicate that UK spending to support its economy could rise to about $60 billion this year. 138 Prime Minister Johnson also announced that all pubs, cafes, restaurants, theatres, cinemas, nightclubs, gyms and leisure centres would be closed. Part of the fiscal spending package includes open-ended funding for the National Health Service, NHS, $6 billion in emergency funds to the NHS, $600 million hardship fund to assist vulnerable people, and tax cuts and tax holidays for small businesses in certain affected sectors. The Bank of England also reduced its main interest rate and supplied the financial markets with additional liquidity. On April 23, 2020, the Bank of England indicated it would quadruple its borrowing over the second quarter of 2020, reflecting a contraction in the UK economy, lower tax revenues, and increased financial demands to support fiscal policy measures. International economic cooperation. On March 16, 2020, the leaders of the G7 countries, Canada, France, Germany, Italy, Japan, the United Kingdom, and the United States, held an emergency summit by teleconference to discuss and coordinate their policy responses to the economic fallout from the global spread of COVID-19. In the joint statement released by the G7 leaders after the emergency teleconference summit, the leaders stressed they are committed to doing whatever is necessary to ensure a strong global response through closer cooperation and enhanced cooperation of efforts. The countries pledged to coordinate research efforts, increase the availability of medical equipment, mobilize the full range of policy instruments, including monetary and fiscal measures as well as targeted actions, to support workers, companies, and sectors most affected by the spread of COVID-19. Task the finance ministers to coordinate on a weekly basis, and direct the IMF and the World Bank Group, as well as other international organizations, to support countries worldwide as part of a coordinated global response. Saudi Arabia, the 2020 chair of the G20, called an emergency G20 summit on March 25 to discuss a response to the pandemic. The G20 is a broader group of economies, including the G7 countries and several major emerging markets. During the global financial crisis, world leaders decided that henceforth the G20 would be the premier forum for international economic cooperation. Some analysts have been surprised that the G7 has been in front of the G20 in responding to COVID-19, while other analysts have questioned whether the larger size and diversity of economies in the G20 can make coordination more difficult. If you liked the video, then please like, share and don't forget to subscribe to our channel.